Hello and welcome to this session. Will include money, banking, financial institutions of the UK and their efficiency. So let us start with money. Money defined can be considered to be anything which is immediately or generally acceptable for the discharge of a debt in exchange of a good or service. In most cases, a liability of the government induced into an economy by making a transfer payment to a firm and a household or by purchasing assets. To be used as a measure of value, money must be expressed in units and stable in fiscal value. The money which we use day to day for purchases in life is conducted as a transfer of national currency. Put simply, money is a complex measure of value regularly used to buy goods and services. This may take many forms, such as coins, cheques, debit and credit cards. However, it must always be portable, durable and practical for the transaction tasks at hand. Where the criteria cannot be met, historically people have tended to revert to a system of barter. Barter is the direct exchange of one good or service for another. This becomes lengthy and impractical since there is no divisible unit of value, in many cases making agreements appear unfair to one party or another. In addition, there must be coincidence of wants, with both parties having some good or service that they find desirable by the other. Historically, there are many examples of this, but for example, today in rural societies, or less developed societies rather, to exchange a sheep or a pig for a camel, some people would find a sheep or a pig or a camel more intrinsically of worth than they would the other creatures. Functions of money. Several main functions of money have been identified by economists, with some additional functions which are thought less credible by some economists. Main functions and characteristics include the fact that it must be a medium of exchange. People are willing to exchange their goods and services for money. A store of value. People are willing to hold money as it generally keeps its value, a measure of value. Well, although it does not counteract inflation. Unit of account. People can measure the value of things in terms of money. Where money is borrowed, it requires lenders to demand interest be paid at the end of or during the repayment term. The account aspect allows sums of money to be recorded and or different values to be added or compared. Standard of deferred payment. People are willing to accept money as payment in the future, for example when the work is completed. Cases where money has failed to facilitate its function. The hyperinflation in Zimbabwe caused people to lose confidence in their domestic money supply. Many workers in agriculture preferred to be paid wages in produce rather than their unstable monetary measures. Subsequent agricultural production dropped, and after controversial land seizures, exports subsequently falling and foreign direct investment bottoming out. This resulted in heavy borrowing from foreign banks to correct the liquidity problem domestically. Unfortunately, the country could not even meet its loan repayments and began printing money in an attempt to meet its obligations. Eventually, inflation reached 1,000,000% and all local confidence in their currency dissolved. In addition, the German hyperinflation situation during the post-World War I period of 1922 to 23, shopkeepers found it useful to quote products in US dollars while payments were made in German marks. There have been instances where money has taken different forms rather than reverting to barter. Prisoner of war camps used cigarettes as money. In the 19th century, gold and silver coins were also used. While both are examples of commodity money and ordinary goods with consumption use and industrial use respectively, they also serve as a medium of exchange. This contrasts with depository notation. For example, a £10 note is worth more intrinsically than its component parts, quality, paper and ink, etc. Here the token money is economised by society on a scarce resource used during the production of the medium of exchange. Money is printed on rare paper with unique or regulated inks being used in its formation. However, the survival of token money requires it to have its supply limited by regulation, and often by law, private production being made illegal. This makes token money legal tender and is universally within the borders or confines of its economic area, accepted as a means of payment and exchange for goods and services. When doubt is cast on intrinsic worth promised by the government of the currency, then it becomes deemed a poor store of value and preference is given to alternative means of payment. Depository notes are IOU money. The debt is to the bank. Similarly, when you have a bank deposit or the bank owes you money and is obliged to pay up when presented with a cheque. Therefore, bank depository notes are only a medium of exchange when they are generally accepted as such. Banking. Banks are unique as institutions in that they play an aspect of human nature for profit. That is, people like their monetary wealth safe from theft in order to save it for the future. In consequence, banks can use their liabilities as a medium of exchange. Cheques are used as deposits and therefore money once again to be loaned out for a profit at a percentage rate of interest. The clearing system. This process of interbank settlement occurs with net result flow returning to the bank of origin. Because many securities are very liquid, banks lend short term and still get monies back in time for depositors withdrawing money. However, loans to households and firms are very liquid. Therefore, banks in modern times require reserves in their vaults to cover liabilities. Liquidity, therefore, is the cheapness, speed, and certainty with which an asset values can be converted back into currency. Liabilities of commercial banks include sight checking accounts and time saving account deposits. Banks therefore make profit or money by lending and borrowing. To attract inward investment, they offer base interest rates to those making deposits, higher in time deposits than sight deposits. They therefore make business decisions based on what is profitable to invest in or lend on compared with what they have to borrow. Historically, UK banks hold deposits that are only 2% of sight deposits that could be withdrawn at any one time. To put it in really straightforward terms, UK banks hold deposits that are only 2% of sight deposits that could be withdrawn at any one time. That means 50 times, historically, 50 times the amount of sight deposits they have, they could withdraw. Historically, this has been corrected through regulation, and historically it's been a 10-to-1 ratio of lending to commercial resource being held on account. Measures of the money supply. Currently, two measures exist for measuring domestic money supply in the UK. MO, or M0, includes notes, coins and operational balances of commercial banks held at the Bank of England. In other words, narrow money, or the medium of exchange function measurement. M4 consists of notes and coins in circulation and in the UK sight and time deposits held in UK banks and building societies. This is known as broad money, the medium of exchange and the store of value function assessment. In front of you can see an M4 money and supply graph in the UK for recent years, just to give you an indicator of how the monetary stock has grown gradually over time. It extends from approximately 1983 on to 1984 through to 2006-2007 and is stated as of recent years, extending from approximately 100 to slightly under 1500 in 2006-2007. The liquidity spectrum on money supply in the UK. As we've discussed, historically there are normally two categorisations that are used, which is M0 and M4. The liquidity spectrum represented in front of you from cash, which is more liquid, saving accounts depending on what's required, through to investment accounts, through to gilt-edged securities, through to physical assets, such as houses. While the store of value function may be higher in something like a house, the medium of exchange may not be there because it can take a certain amount of time to discharge the value from your house. For example, the time taken from agreement of sale through to actual sale can be several months to years, depending on the size of the asset to be discharged. Therefore, two broad categories are given: the more liquid, such as cash, and savings accounts, depending on what's required, being known as narrow money, and the less liquid assets, etc., being known as broad money. It's not to be confused, the liquidity spectrum, with the investor liquidity spectrum. Now, strictly speaking, you're not going to find this investor liquidity spectrum on any A-level or degree course for economics, because it's a different thing, but it will come up if you ever read the newspaper, watch the news, or do a professional finance qualification, for example. So I thought I'd put it in just to clear that aspect up. As a consequence of that, if you look in front of you, cash is very liquid. Art supplies, instruments, specialty goods, things like that, they're not normally included in M0, M4, any supply of official talk about what's included in the monetary stock or liquidity spectrum. But they could be thought of as having a value and therefore medium level of liquidity. So I've put this in for clarification: from the very liquid, such as cash and mutual funds and stocks, through the medium level, art supplies, instruments, specialty goods, to the totally not liquid or illiquid things such as real estate, part ownership in a business or artist or corp, or artist corp. As I said, it's not to be confused with the liquidity preferences of the investor. We've been talking about liquidity from a perspective of the money supply. Should we have considered liquidity from an investment perspective of the individual consumer or investor in society, then we'd have to consider this as represented in front of us now.